Hello, everyone. Welcome to the GCP podcast Under the Gulmohar Tree. Just as the Gulmohar Tree symbolizes growth and resilience, Under the Gulmohar Tree brings operators, investors, and M&A professionals together to share insights on scaling mid-market businesses. Through candid conversations, we explore leadership, innovation, and value creation, uncovering lessons and strategies to help you grow and thrive. Welcome to the GCP podcast, Craig. You and I know each other for a long time. Just for the audience, do you mind doing a quick introduction?
Well, sure. Glad to. I'm Craig Jones, and I'm the managing partner at TPE Boulder, which is based in Boulder, Colorado. And for the last 15 years, we've been making equity investments in what is known as the low end of the middle market in majority control transactions, in our case, in healthcare services, software, and business services.
Perfect. Thank you, Craig. You've had a remarkable investment career across venture capital, private equity, and search fund asset classes. Could you describe your journey and what initially drew you to these industries?
I was drawn to first to venture capital when it was a fraction of the size that it is today. And it was gaining fame through the IPOs of companies like Apple Computer, and on the biotech side by companies like Genentech. And for example, when I joined Centennial Ventures, actually right here in Colorado, there were only 3 venture capital firms in the entire state. And the total funds under management for the entire industry in Colorado was less than $50 million. So what drew me to my career actually, began in healthcare. And I was drawn to the ability of innovation to advance human health across a lot of different dimensions. And it was from there that I began to do software deals within the healthcare industry. As you can imagine, this is an enormous industry, and it's today close to 20% of the entire GDP. And so it is incredibly complicated with both the private and the public side. And so software had a role to play in making the industry more efficient. And so in the 90s, I was doing healthcare deals. By the time 2000 came, I began to take my software experience and apply it outside of the healthcare field in a whole variety of industries. The SaaS industry began with Salesforce.com, and then began to see the advantages of hosted software during the OOs. And I came into software through healthcare and have continued to see that small, well-managed companies can make a dent, in your corner of the universe.
Perfect. Thank you, Craig. So, with the evolution and maturity of these asset classes, and the AUM has exploded, rightfully so, right? These are producing great returns for the LPs. How has your investment strategy evolved over the years? And what factors do you prioritize while evaluating a potential software investment?
Well, it's interesting because the question, I get asked this question all the time: how do you find small software companies or some combination of software and services when the venture capital industry tends to jump on the biggest opportunities and the fastest growing companies, et cetera? But what a lot of people don't realize is that there are literally thousands and thousands of North American software companies that have been built the old-fashioned way by founders who knew their vertical niche extremely well, and with the backing of a small set of clients, began to develop software and used cash flow generated by those contracts to build their company. Now, anywhere from 5 to 15 years later, these are highly profitable companies. No, they're not growing 100% a year typically, but they're still growing. And their single greatest area of expertise is their vertical industry knowledge. So we look for not the largest markets. In fact, in many ways, we look for small markets. We look where a small company can make a difference, and by just careful attention to what features and functions and ease of use matters to the end customer, they've been able to develop a highly successful company that's not doesn't have customer concentration, has an entrepreneur who knows that industry well, has a set of legacy clients that continue to educate the employee base of that company to continue to expand its competitive advantage. So we're heavily, guided by the Rule of 40, which, as many of your listeners know, is a financial shorthand for just saying software companies that are growing 20% a year and have 20% EBITDA margins. And why is that important in a small leverage buyout? Because you need cash flow to pay down the loan, and you need to have growth in order to graduate from the stage that you're at. So in this low end of the mid-market, there are two absolute keys. One is that you're buying in at a reasonable valuation because the venture capitalists aren't interested, and because it's below the radar screen of the large private equity firms. And our goal is to help the management team grow those companies to the stage where it is of interest to the private equity industry. And so the paradigm is we get in when demand isn't great for these companies. When you grow the company, double or triple the size, and you get the private equity industry interested, then the number of buyers grows exponentially. And that's the economic paradigm that we live in. And so the Rule of 40 is important because the entire reason for existence for a small company, if it's not owner operated and just a lifestyle business, is to grow. You have to grow faster than the average PE company. So that's where the Rule of 40 comes from. We look for whether or not the price point that has produced the revenue and the EBITDA, it provides a competitive advantage, whether or not the ease of use is as good or better than the competitors, and whether or not the features intersect with what is most important to the customer base. And some of that's self-explanatory. In other words, the company wouldn't have the revenue and EBITDA it has and wouldn't be growing if it wasn't doing something right.
Perfect. Thank you, Greg. Just to double click on the Rule of 40, as you know, I love it. Do you prioritize higher growth versus EBITDA on that Rule of 40? Or is it equally important? How do you think about that?
In the software world, we put even more emphasis on growth. And so the deal won't work for us. It won't work for shareholders. It won't work for the employees if you're not growing. And it's not enough to just say, well, the existing management team hasn't been prioritizing growth. They don't have enough salespeople. Typically, if there's growth opportunity, the company's already growing nicely. So, but you do need enough EBITDA to handle whatever level of debt you have. So there's sort of a minimum criteria that you can both pay the interest on the debt, and to the extent there is amortization, provide for that as well. So that's sort of a minimum table stakes. It doesn't necessarily have to be 20%. That could be 15%. But the growth is the absolute most important issue.
Thank you. You touched upon two very important things, Craig. One is the management team. Second is the nature of lower middle market software investments, and I'll ask you these questions one by one. So, the first question is, what qualities do you look for in an entrepreneur or a CEO when considering that investment? And how can they stand out to investors like you?
Well, first of all, let me just step back for a minute and say we do have sort of three different models that we use. In some cases, the original entrepreneur has already replaced himself with an executive that we like. So he's been at this for 15 years. He knew he was going to sell a majority control of the company, and he's already put somebody in place. The second is that he's getting two bites of the apple. And the two bites of the apple, he sells maybe 75% of it, his interest, holds on to 25%, with the hope and expectation that if we make four times as our money, he's going to make as much on the second bite of the apple as he does the first. And the third paradigm is where the investment group is bringing in an entrepreneur, either through a search fund with the person that did the search, or in the case of an independent sponsor deal, for example, where we've recruited that CEO sort of simultaneous with the deal coming together. So those are the three paradigms. So what do we look for in that leader that is running the company? Well, I'll tell you right now, this is not a popularity contest. So you're not running for student body president of your high school. You're a leader of a business. So the absolute most important ingredient is that you have a vision for where you want to take the company and have a pretty good understanding of the process steps that are going to be necessary to get there. Leading in the wrong direction isn't going to do anybody any good. So the number one issue is whether or not you have a strong viewpoint about where to take the company, and preferably have some experience in your background of having done that in the past. We look for a cost consciousness. So in a small company, you have to do everything, as you well know from your experience, with very limited resources. And so it's very different than working for a big company. And time again, myself and my peers have made the mistake of bringing in someone from a big company who then wanted to hire some very well qualified, expensive person for every single possible function at two different levels down. And by the time you're done, your EBITDA is gone. So you have to be extremely cost conscious. The other thing is that they are have an extreme sense of urgency. So they know that the single most valuable thing that all of us have is our time on this planet. And you've got to move these companies extremely rapidly. So there has to be a vision, cost consciousness, extreme sense of urgency, and it certainly helps if they already have an intimate knowledge of the end market that the software company is participating in. We always say that the code that the company has is not its competitive advantage. The competitive advantage is its knowledge of the vertical market. And that's reflected then in the code that is written for the company.
Thank you, Greg. That was super helpful. Now, touching on the other item that I was talking about, trends in the software market today. So obviously, it's a tricky market, high interest rates compared to a few years ago. M&A is not as strong as it used to be. However, it's getting better through our own observation. So what trends are you currently seeing in the lower middle market software investments today?
Well, there's an explosion in the number of companies. And we have a experiment going on right now across alternative investing. And you're seeing that, in my opinion, most starkly in the venture capital world, where there's really there's too many companies, and there aren't enough exit opportunities for those companies. And there certainly aren't enough that can go public. Some of them are doing secondaries. There's been a lot of maybe private equity firms buying venture-backed companies, but there's a cliff of just oversupply of venture-backed companies. On the low end of the mid-market, that's less severe, but there certainly are baby boomers retiring at a record rate, which creates a great supply. So it's great to be a buyer. It makes it harder to be a seller. As you point out, interest rates, our market peaked in 2021. We all thought we were brilliant. Since then, our IQ has dropped. So it's much harder to get out of deals at extravagant valuations. Interest rates today in the larger LBOs peaked at about 9% average and is now down to about 7.5%. But at the low end of the mid market, you're paying a significant premium to that. So you're paying double digit rates often for the companies where senior debt is not available and you have to go with mezz. That puts even more pressure on the need to grow the company rapidly so that you can make up for the higher cost of capital. And it also importantly puts even more pressure on buyers like myself to strike reasonable deals at valuations that you can then have a multiple expansion on when you sell the company.
Thank you so much, Greg. That was super helpful. Continuing on that thought, so we talked about the trends. Maybe can you talk about how is the software landscape evolving in the next 5 to 10 years according to what you see today? Obviously, AI is proliferating. Every single industry out there, everybody's talking about the Gen AI and its implications, and some good and some bad, right? If you look at it from a cybersecurity standpoint, the attack vectors are increasing, but the many goods are coming out of it too. What do you anticipate the software landscape to look like in the next 5 to 10 years?
Well, so software has quote unquote been eating the world for a good 20 years now, and going back even further. But every aspect of every business transaction in the world is being driven by software, and it's being customized for every niche, etc. And so there's no end to that. That'll continue on. So I'll just give you some flavor of some deals that we've done in the last year. And again, focusing on smaller niches rather than enormous niches. So we invested in a company called Growth 99, which provides software and services just for one physician practice management niche, which is the aesthetic marketplace, just in new patient acquisition and patient engagement. So a vertical niche in terms of a specialty within a PPM, and then secondly, one application, CRM within that application. When you can combine those two brilliantly, then you have a chance to gain market share. And you got to make it work for these small businesses that have physician leadership whose time is extremely limited. Another example is we combined two companies together in the private aviation maintenance industry. So everybody that flies a plane privately has certain FAA requirements, not to mention that they have a strong self-interest in making sure their plane stays well maintained. And those maintenance shops have been working on clipboards, and they're still, believe it or not, in 2025, still a lot of the market that needs to be digitized. And our company, by combining two small companies, by providing a good price point, by providing a broad set of features, is penetrating that industry. Not a huge industry, but a plenty good enough business to grow something that will have, probably sell at an ARR multiple, 5 years from now. And we've done the same thing in the cruise industry, something you might not even think about. Cruise ships are something that is both a ocean-going vessel as well as essentially a hotel and resort. And our company, IT Cinch, provides software for both sides of that and is expanding into other areas of maritime. So I use those examples because we're not generally investing in companies that have a general application that is applicable across 20 industries. Getting to your issue about AI. So, the AI most recent revolution is still very young. So we're only a couple of years into it. And these large libraries that have been assembled that require billions of dollars to do, that's a venture capital play. And the application side of it is starting to come out in 2025. And it will now be up to small companies to figure out how to use what ChatGPT and other companies, Google et al., have done to make a difference in their small areas. So, for example, the biggest single impact to date has been the software industry itself. So I have heard from my portfolio companies anything from a 25% to a 75% increase in productivity, which is astonishing because one of the biggest problems that we had for the last 20 years has been availability of talent. And that's not going to end, but the difference is you can now leverage your talent in a way that allows you to be even more productive than ever before, to develop quicker, faster, add features quicker. And so that is making software even a better place to be because you can develop features that are important to customers at a lower cost.
Completely agree. Thank you, Craig. So as we are coming up on time, I want to ask you two final questions. You've been on many boards, including Voxco. Thank you. And I got to learn so much from you. So now for board directors, including myself, who don't have as much experience, what advice do you have for newer board members as they are getting to now sit on multiple boards? And also, what do you believe makes a strong, successful board? And you've been in the chairman role in many of those too. So it's a two-pronged question. How do you approach your role as a chairman in these boards?
Yeah, so being on a board of directors of a company, is especially a small company. I think that the most important principle is one, develop relationships, strong relationships, starting most importantly with the chief executive officer of the company. So, and the second is to be transparently, almost brutally honest. There's no sense in hedging your words. There's no sense in trying to, just get along. That doesn't cut it in small companies. So the challenge for the low end of the mid-market is that these deals are often syndicated, meaning that you have multiple board members from multiple firms on that board. So it is a team sport in that sense. Whereas a large private equity firm that's going to own a majority of the company might have a single point of view. So that is both a strength and a weakness in these highly syndicated deals. And so the strength is that you have multiple viewpoints. You have different people with different backgrounds, and they aren't all talking from the same hymn book. The challenge that presents for the chief executive officer is how do I synthesize all these views together? So look, you're not going to win every vote, but you as a board member owe it to your CEO to have your own strong viewpoint about the best path forward. In the end of the day, it's got to be the CEOs. The number one job of a board is hiring and firing the chief executive officer. And if you have a viewpoint, the CEO's is different, you're going to go with the CEO's viewpoint unless you think he's going off a cliff. And so you have to develop that strong relationship with the CEO. You have to give your views repeatedly and strongly and talk about what specific things you would like the company doing differently if you think they should. And that you owe that level of stubborn honesty to your CEO.
Thank you, Craig. That was super helpful. Finally, the last question is what advice you will give to someone who's still trying to break into the private equity or the search fund space as an investor, question number one, or as an operator, question number two?
Well, I don't think there's one path to success in any industry. There's really a mixture. If there is one thing that definitely, in my opinion, often differentiates people, it is having operating experience. So if you come out of school and you do you come out of undergrad and you do the investment banking thing, and then you get an MBA, you might and let's say you don't have a company you want to acquire right away. You're not comfortable that you're at that stage of your career, you're still in your 20s or whatever. Join a company, have an operating role, develop and develop a keen understanding of how difficult it is to run a small company on limited resources. And the other piece of advice I would give anybody is whatever you're doing, make sure you pick your mentors. Have strong mentors, either in the private equity firm that you're joining, or if you're raising money, make sure that you can learn from the people you're raising money for. So as I go back and personally think about the most rewarding times in my career, they clearly were where I thought I could personally move the needle. And I certainly have examples of that over my career. And, when I think back to when you were running Voxco and you and I would sit down and talk about the future of the company and figure out what the drivers were for success. And when you have that meeting of the mind and fortunately have a CEO who's able to execute on that, that's tremendously rewarding.
Completely agree, Craig. And thank you for being my mentor as a young CEO. I definitely can vouch that that was the most important thing for me to step into a role that I've never done before. And I completely appreciated your brutal honesty, as you mentioned. And I hope that I can be in the same shoes, the big shoes that you've left for me, and look forward to collaborating on many different things soon. So thanks once again for being on the podcast. I'm sure our listeners will enjoy it immensely. And we will definitely want to have you again in some other forum. Thank you once again, Craig.
It's my pleasure, Sumit, and best of luck to you and your associates and all the great things you are doing.
Thank you.